Okay, so I think it's a good time to get some logistics out of the way. Welcome everyone to our second seminar of the Spring WEFI series. Happy everyone is here. As a reminder, format, we've got 40 minutes for the presentation, 15 for the discussant, and then we'll have a 5 to 10 minutes depending on the activity for Q&A. The presenter has said that she's open to interruptions for clarifying questions and otherwise. On top of that, a co-author is in the room, so virtual room. So we also encourage you to use the chat for those kinds of questions. It's certainly up to you, but I think it's a little more lively if you feel like your question is worthy of public announcement, please do. And also, we'd love it if folks had their cameras on. I think many in the room have taught on Zoom before and know how, well, depressing is a little strong, but how weird it can be to speak to a bunch of boxes that don't move and headshots. So it would be great if at least some of you could put your camera on. We really appreciate it. Okay, with that, let me get my timer ready. I'm going to hand the floor off to Manasa, who's going to present the dark side of entrepreneurship. The floor is yours.
Great. Thank you so much for including our paper in this wonderful series. So I'm going to talk today about the dark side of entrepreneurship. This paper is co-authored with Sudheer, Chava, Manpreet, Singh, who is in this room and is happy to answer questions, and Yafei, Zhang. All of us are at Georgia Tech. Okay, so our paper is motivated by the fact that entrepreneurship has been a very reliable and robust engine of economic growth and employment in the US. So nearly 10% of all workers in the US are self-employed. And as a result of this, there's been a lot of interest in the academic literature as to what the returns to entrepreneurship are for this individual choosing to enter into entrepreneurship. Very early literature suggested that entrepreneurs are maybe earning less while bearing more risk than salaried counterparts. But more recent literature suggested that once we actually identify these entrepreneurs correctly, and we can separate entrepreneurs from other business owners or self-employed workers, then the net returns are positive. And in addition to this, maybe looking at just averages is not the right way to measure returns to entrepreneurship, because there might be an option value from experimenting. So there's a high variance in the income of self-employed earners. So this variance gives an option value from experimenting with entrepreneurship. And if they do fail, maybe the costs are not too high because they're able to re-enter the labor force in case of business failure. Okay, so given the more recent literature on the benefits of entrepreneurship, our paper is going to focus on whether these benefits through income, so on, actually translate to improvements in the personal creditworthiness of the entrepreneur. We focus on creditworthiness for multiple reasons. The literature has documented how personal creditworthiness affects a multitude of outcomes, from labor mobility, employment opportunities, consumption, investment, so on for the individual, as well as can have large macro effects. So in this paper, we're going to look at what the transition of entrepreneurship does to the personal creditworthiness of the entrepreneur. So ex ante, it's not obvious what could happen to this relationship, primarily because, as the literature has documented, if there are increased income wealth benefits from the transition, then it could lead to potentially lower demand for debt for the entrepreneur, or increasing creditworthiness as leverage of the entrepreneur falls. But alternatively, we know that entrepreneurs have to borrow to finance either the business or personal needs. Given entrepreneurship is this non-diversifiable risk, and there's a lot of uncertainty in income. It takes typically a few years for business to reach profitability. So there's initial uncertainty in income, so the entrepreneur might need to borrow to either smooth consumption on the personal side or to finance the business itself. Because anecdotally, we're aware that most entrepreneurs, they fund their business through personal savings, and the average individual in the US doesn't have high levels of savings or reserves. Okay, so given the income uncertainty, lack of savings, So either the individual has to reduce consumption, or they might have to borrow to smooth consumption, and they might have borrowing needs to finance the business itself. So ex ante, it's unclear what is the impact of the transition on the debt levels and the credit worthiness of the entrepreneur, and that's going to be the focus of this paper. Before I get into all the details of the paper, I just want to provide a brief summary of our results. So as expected, the type of individuals who start businesses, they tend to be observably better than non-entrepreneurs. So in our sample, the entrepreneurs, they tend to be younger, they have higher income, they have higher credit scores, they have better credit conditions as compared to the average consumer in the US. But once they start the business, we see two things. We see that the debt level of the entrepreneur increases. Their leverage is about 8.5% higher, even 5 years after starting the business. And perhaps surprisingly, they're more likely to start defaulting on their loans. So we see that their delinquencies on loan accounts increases by about 19%, and they're about 38% more likely to file for bankruptcy relative to a comparable non-entrepreneur. In the cross-section, we show that high-skilled entrepreneurs, they do tend to have lower levels of delinquencies, but the rates of bankruptcy are just as high for high-skilled individuals. We also explore whether making it easier to transition into entrepreneurship by reducing the cost of running a business helps an entrepreneur. And we actually see that it's not sufficient to offset the negative impact on credit. And in fact, it leads to entry of observably worse quality entrepreneurs. In the end, we'll show you some suggested results on how borrowing on high cost debt leads to these deteriorating personal credit conditions of the entrepreneur. Okay, so our paper connects broadly to two strands of the literature. As I was mentioning in the motivation, it relates to the strand on what the returns to entrepreneurship are. And largely this literature has focused on the impact on income and wealth, but we think if we don't take into account the impact on the credit worthiness, we miss an important part of the true returns to entrepreneurship, because credit worthiness has large impacts on all of the consumption, saving, investment behaviors of an individual. We also relate to the literature on how changes in personal credit affect entrepreneurship. So we know that increases in personal wealth or increase in collateral value of the individual leads to higher levels of entrepreneurship. Here we're going to look at the flip side, and we're going to look at how entrepreneurship can in turn affect the personal credit of the entrepreneur. Okay, so how are we doing this? So we're going to start with data on the universe of trade line level consumer credit panel that comes from Equifax. So in this, we have monthly records of all of the credit information of all individuals in the US who have a credit score, which is most of the adults. So we have information on their credit scores, their balances on different accounts, the loan performance of each of the different loan accounts, as well as whether the individual files for bankruptcy at any point in time. This is then combined with demographic information about the individual. So we know their age, where they live, their income, which is a modeled income. And we combine this consumer credit panel to information on business registration that comes from the Secretary of State. Okay, so we have all these incorporated businesses that are at the Secretary of State linked to the consumer credit panel. And we follow individuals for about 2 years before they start their business and for 5 years after the start of the business. So our sample of business starts is between January 2012 to December 2016. And we followed 2 million entrepreneurs for about 84 months throughout the sample. Okay, we see that on average, as expected, the people who start businesses, they tend to be richer, either measured by the level of income, or if we can use mortgage as a proxy for wealth, we see that richer individuals are more likely to start businesses. Having high level of credit score helps with business start, but only up to a certain level. In fact, individuals with very high credit scores are less likely to start businesses. We also see that likelihood of starting a business peaks at around age 40 and then drops. On average, men start more businesses, and as a proportion of the population, we had white people starting more businesses, but in recent years, that trend has reversed and we see a lot more minority business owners. We also see that educated individuals, so ones with college degree, are more likely to start a business. And as we've seen in the literature, having house or housing collateral helps with new business formation. So why do I show you these? Just to show you the idea that there is a lot of difference between the type of individuals who start a business. Okay, so observably, entrepreneurs look quite different from non-entrepreneurs. So our primary challenge is going to be in finding a comparable control group to compare the personal credit conditions, the trends to before and after the start of the business. Okay, so the first thing we're going to do is we're going to match entrepreneurs pre-business start credit conditions to non-entrepreneurs who look similar to them. Okay, so we're going to look at non-entrepreneurs who live in the same county, have similar income, have similar credit scores, have are around the same age, whether they own a home or not. And then we're going to do a nearest neighbor match on both the level as well as the trend of credit scores and leverages. Okay, so this will create an observably comparable sample of non-entrepreneurs who we can follow alongside our entrepreneurs. Just to show you, before matching, as the summary suggested, the individuals who eventually become entrepreneurs, they have higher credit scores, they have higher income, they tend to have higher leverage. They're younger, they're more likely to own a home. We match explicitly on these dimensions. So we see that after matching, observable characteristics of these individuals are very similar. And even on the dimensions that we don't explicitly match, we see that our entrepreneurs and non-entrepreneurs are now similar. So we have similar level of likelihood of being delinquent on loans, bankruptcy, the level of debt, and so on, before the start of the business. Okay, before I get into the empirical strategy, maybe I should pause for any questions.
Perfect. Well, I'll take one. Back to the matching.
Yes.
I mean, it's an impressive match, the ability to do this. What do you want us to have in mind for the non-entrepreneurs? I mean, I guess I'm looking at this and thinking you found a bunch of people that live nearby that have similar financial characteristics, but like don't have an entrepreneurial idea. Is that what we should think of? Or could this be like what are you missing in the matching that could be driving the non-entrepreneurs, given everything else that's the same, for them not to be an entrepreneur?
Yeah, okay. I think one thing that's probably true throughout this paper is, there are going to be unobservable differences between these entrepreneurs and non-entrepreneurs that make someone start a business while the other chooses not to. And I think we are very upfront of the fact that there's no way we will be able to get into this entrepreneur's head and figure out what leads them to start a business while someone who looks very similar to them, maybe, on like demographics or financial characteristics, chooses not to. But I think what's also important to mention is that's not going to be critical for what we want to convey in this paper, which is that what we want to show is like observably, these financial characteristics of individuals are going to shift once they make this transition to entrepreneurship, which is obviously not random. It is a choice that they're making, but what is the, return or the cost of making this choice is really what the focus of the paper is going to be. I don't know if that answered your question, but I think we completely agree that we won't be ever able to randomize this entry into entrepreneurship.
That helps. I think whenever we do a matching exercise, it's useful to think about sort of what is like the top two confounds that are missing? And I think you've answered it. Well, we don't know, but one is probably I had an idea and the other one didn't. That's ideally what would happen, right? One has an idea and one doesn't, and one starts a firm.
Okay, so what we do in this paper, though, is we want to actually compare how the financial conditions of the entrepreneurs change relative to a non-entrepreneur after they start the business. Okay, so our outcome we're going to be looking at will be the personal borrowing as well as creditworthiness, which we're going to measure by two different outcomes. We're going to look at being delinquent on loans, which we're going to use the definition of 90 plus days past due. And we're going to look at whether they file for bankruptcy. And we're going to compare individuals within this matched pair of entrepreneur, non-entrepreneur after the start of the business. Okay? So our coefficient of interest is this beta on outcomes of the entrepreneur post-business start. And this is a stacked event month panel design following individuals from about 2 years before they start the business to 5 years after the start of the business at the monthly level. So the reason we follow individuals for 5 years after is we want to see not just the short-term impact on debt or creditworthiness, but rather the long-term impact on the individual's creditworthiness. Okay, so we're going to start with looking at the level of personal debt of the individual. As I initially suggested, there are two things that could be happening, right? As the literature has shown, if it's leading to higher levels of income from making the shift to entrepreneurship, maybe there's a need to borrow less, or even at similar or higher levels of debt, maybe there's a lower level of leverage as income goes up. But on the other hand, you might need to finance the start and operations of this business. Typically, if markets were ideal, if you had a good idea, you could finance the business through the business balance sheet itself. But as surveys from the Fed have shown, most of the entrepreneurs, they tend to rely on personal funds to provide business financing. And there is uncertainty in income after making this transition to self-employment, because in initial years, it could take time for the business to become profitable. And if individuals don't have sufficient savings, they might have to adjust either consumption or debt. But if this uncertainty is just a transitory effect, maybe the changes in debt or leverage is temporary and it returns back to pre-business start levels. Okay, so we're going to focus both on what happens immediately after the start of the business as well as in the long run. Okay, so just to show you raw trends, comparing entrepreneurs and non-entrepreneurs, we see that prior to start of the business, both entrepreneurs and non-entrepreneurs, they seem to be on parallel trends in different measures of levels of debt. But immediately after start of the business, we see that for the entrepreneur group, the level of their credit utilization, their balances, as well as leverage tends to increase. So the one thing I want to caveat here is when we measure debt to income here, it's based on modeled income. So typically when you apply for a credit card, you might fill out, what your income is, but it's not always verified, and you might not update it once you already have an account outside. So it's typically modeled income. It might not represent the accurate level of income. Okay, so we're going to come back to that, but it seems like once the individual starts a business, their level of debt is increasing. Okay, so this is just showing you that in a regression table, so both in the short term and in the long run, the level of debt is increasing. So about 5 years after starting the business, the leverage is about 8.5% higher for the entrepreneur relative to the matched non-entrepreneur. Okay. All right. So as I said,
Manasa, you want to answer some of the questions on the chat? I think it's easier if you just answer them on the chat.
Sure. Is it easier if I just open up the floor and they can ask the question?
Was this my question? Or Melanie's?
So I think
Melanie's and yours, I think both of them, I think I've not answered both. Yeah.
Okay.
Yeah. So there was one question by Melanie. I think there's one question on the risk tolerance that, the people who start business versus those who do not, there's a difference in the risk tolerance. That's one question by John. And then Melanie has a question related to that. And then finally, Mike has a question on, that these gaps in our figures that we showed before, even after the matching, the difference still looks something similar. So you probably want to answer.
Okay, yeah. So I think just to go back, so what we're matching on are the credit scores, the income, the total debt to income, the age, and the home ownership, right? So within, say, even the same leverage, you can have different composition of debt, right? Which is why you might not see the credit card utilization, for example, being the same across these borrowers. So we chose to match on total leverage. If you have suggestions on maybe we should do a match both by, I don't know, level of credit card or non-mortgage balance and mortgage balance separately, I think we can just definitely try that as well. Okay, so that I think is the answer for the gaps. Then about the risk tolerance. Yes, I think agreed. So yeah, so we, in this set of results I'm showing you, we didn't explicitly match on race and gender, but in some of our additional tests in the paper, we did try to do cuts by gender or race, and we didn't see differences in outcomes across these, which is, but like we can definitely do the additional levels of matching if you think risk tolerance might be different across these groups, and maybe the best comparison would be within the same race, gender. Did I miss any other questions?
No, I think you're good.
Manasa, can I ask a question?
Sure.
So I presume you're probably interested in knowing what happens to the career, or what happens over the career of this individual, right? So the 5 years may not be enough, because who knows what exactly they're going to be able to build on this particular success or failure, right, in the future.
Yeah, I agree. I think part of that is really just data restrictions, which is our sample starts in 2010. We wanted some initial period before the start of the business so that we can make sure, like we actually find a reasonable control group. And we wanted to follow individuals for a few years after the start of the business, but we didn't want COVID, confounding some of our results, which is why we stopped right before the start of COVID. So our sample goes on to like December of 2019, which restricts how far ahead we can look. But yes, I think that's a fair point. We can, at least maybe for like an initial set of entrepreneurs, we can look at a larger window, or as we get more data now, we can extend the sample. But I think even, and maybe if you wait a couple of slides, you'll see why even this impact, say 5 years out, does say something about the long-term implications for creditworthiness. Because, for example, we look at the filings of new bankruptcy. Okay, so once you have a bankruptcy flag in there, that's going to be on your personal credit records for say 7 years out from that point. Okay, so we're already looking at the impact on your borrowing ability or consumption, say 12 years after starting the business. And hopefully if we get more data, we can extend the sample.
Fair enough. Because I was thinking that when you start something like a business, etc., you're going to go through hard times, a lot of uncertainty for a long time, right?
Yeah. So I think, so we thought the 5 years was capturing some amount of that, which is why, if you just look like, say, in the short term, within a year or so, we might not be able to actually look at, initial risk from starting a business, obviously high. I think data seems to suggest that the average business takes about 2 to 3 years to reach some profitability, which is why we thought, 5 years is probably a reasonable window. But yes, as we get more data, I hope we can extend this.
Fair enough. Thanks.
Okay, so I showed you debt level goes up, right? But that could be due to multiple reasons. So firstly, increasing debt doesn't necessarily mean increasing leverage. As I said, our debt to income measure does have limitations because income is just modeled. And even though true income might be increasing, we might not actually capture it in our measure. So if you have higher levels of income, maybe you have higher borrowing capacity, that could be net positive. But if debt is increasing without commensurate increase in income, it could lead to higher levels of debt. But as Naveen was also saying, initially, when you start a business, there is some risk that you're taking, but in the future, it might actually be a great venture that a starter. So if there's high expected future income, you might borrow to smooth consumption. Okay, so we're going to look at what happens to the creditworthiness of the individual itself, both the short run and in the longer horizon. Okay, so what we see, the first outcome we're going to look at is their delinquencies on loans, and we see that as our matching works in the sense that entrepreneurs and non-entrepreneurs are on the same path before the start of the business. Immediately after starting the business, the entrepreneur actually seems to be doing better. The levels of delinquencies are dropping, but this seems to be very temporary. So about 3 quarters after they start the business, their DPDs and loans are increasing, and it seems to stay high even 5 years out after starting the business. If we look at bankruptcy, similarly, we see about 4 or 5 quarters after starting the business, the entrepreneurs are likely to have higher levels of filing for new bankruptcy. Okay, so what this means is, say, if I'm looking at the last value here, so 5 years after starting the business, there is a higher likelihood that the entrepreneur files for new bankruptcy. So this is the first time the bankruptcy flag appears on the credit record of the individual. So just to show you this in a more formal regression table, right? So entrepreneurs have about a 19% higher likelihood of filing for delinquency and about a 38% higher likelihood of filing for bankruptcy. What we see is that this tends to increase over time, right? And this is, as I mentioned already, this is the first time they're filing for bankruptcy. So if they're filing for bankruptcy for the first time, 5 years after starting the business, it's going to affect their ability to borrow, say, 12 years after starting the businesses. I think there were, okay, before I get to heterogeneity, I think there were some questions in the chat. Yeah, okay, so there's questions about gambling for resurrection. Expectation of limited future options might cause entrepreneurship. Yeah, okay, so I think, sorry, so just to understand, is your worry that individuals who enter into entrepreneurship, they might be maybe unobservably worse off because
so Manasa, let me try to explain. The way you're talking about this, I'm getting the impression you're interpreting the evidence as entrepreneurship causes this financial hardship. My point is it could be the other way around, which is the anticipation of financial hardship leads one to explore self-employment. So what I have in mind is I know my parents are going to need a lot of self-care, and my current employment isn't going to offer me the flexibility to do that. I know that there's a big layoff coming at my company, and I'm concerned about that. Or I know that there's a huge balloon payment on my mortgage coming due, and there's no way I can make it with my current income stream. Each of those events might lead me to explore entrepreneurship as an attempt to get out of the bind that I find myself in. And all of those events will have negative consequences for my future bankruptcy, debt, burden, etc. I think your evidence is very fascinating, don't get me wrong, but I'd like to see a little bit more nuanced interpretation of the evidence.
Yeah, okay, I think
in that way, that's all.
Yeah, I think it's fair, and probably goes back to Michael's initial question, right, which is what's leading to entrepreneurship in the first place. And I think we're well aware of the fact that we are not randomizing this entry. At this stage, what we're really showing is correlations of once this individual chooses to make this transition into entrepreneurship, how that's correlated with changes in their financial condition. We do have some ideas for how we could potentially instrument this entry through some changes, but at this point, I fully accept that all we are showing are correlations of what happens to financial conditions.
And
Once
just
this-
as a
Yeah.
comment, even the title is leading, right? The dark side of entrepreneurship implies that entrepreneurship is causing these events. And it very well may be, and I suspect, it contributes to it. I'm just saying there's these other factors that are going on that anecdotally I've seen quite a lot of evidence of that. So
I think that's fair, but so maybe also related to one of the responses Manpreet put in the chat, right? I think we're trying to distinguish whether these are actually entrepreneurs who have maybe some potential upside or some skill by following the literature on actually separating who's an entrepreneur from like a self-employed worker by just looking at some of the incorporated businesses. But I agree that might not fully address the concern that you have. And yeah, it's fair. We should maybe like tone down the title to not imply causality in the title itself. But that's hopefully where we want to eventually get. But at this point, yes, it's correlations that we see. But I'll show you some results in a few slides, which.
And let me
again,
just emphasize, Manasa, I find the correlations really fascinating and important to document. So it's not a huge, the nuance is important.
Yes, yeah. I completely agree with that. Okay, all right. So we see that these average differences across individuals who choose to enter entrepreneurship and non-entrepreneurship. What we now want to focus on is some cross-sectional heterogeneity. Yeah, because we know that in the literature, you tend to think of entrepreneurs as having higher levels of human capital and skill, and that they should be compensated for this skill. So maybe we expect some of these negative impacts to be more subdued if the individual is of higher skill or quality. So we're going to try to proxy for this using a few different measures that have been used in the literature. So we're going to use individuals' level of education, their income, and credit score as proxies for the entrepreneur's skill and sophistication. And here's what we see. We see that on average, the individuals who tend to be more sophisticated have lower levels of delinquencies after the start of the business. But what's interesting is we don't see any difference in the likelihood of filing for bankruptcy across these groups. Okay, so even the high-skilled individuals are just as likely to file for bankruptcy after the start of the business. We don't, at this point, have the best explanation for this. So if any of you have suggestions on what could potentially be happening beyond just maybe like a strategic filing of bankruptcy or how we could test that, I think we're very open to those suggestions. The next thing we explore is actually whether local governments and state policies can help reduce these negative impacts that we're seeing on the personal credit of the entrepreneur. Okay, so the idea is if you can lower the cost of running a business, it should potentially help the entrepreneur and reduce the burden on the personal balance sheet. But there's a lot of variance in how much support small businesses, entrepreneurs receive across the different states in the US. So for example, states that have higher taxes, maybe they make it harder to start a business, they can distort investment decisions and so on. So we're going to look at across the different regions in the US, the level of support that individuals get, and we're going to measure this using the Small Business Policy Index. Okay, so this is based on measures that are related to the level of tax in the state, the rules and regulations, how much government spending, how effective the policies are. And what it captures is if the business policy index is higher, then it suggests that the state is less friendly. So just to give you an idea, right? So the states in green, so these are the most business friendly states, so the ones with the lowest scores. And the states in red are the ones in the highest terciles of the policy index. So as we can see, we have states like Texas and Florida in being the most business friendly, or like California's and New York and the other extreme. Yeah. So there is variation in the cross section, but it tends to be very sticky over time. So again, what we're going to show you are going to be correlations of this policy index on impact of personal credit conditions of the entrepreneur. And what we see, interestingly, is that states that are more business friendly actually have entrepreneurs being more delinquent and filing for bankruptcy more often. Okay, so if you increase the friendliness of state policy by about 1 standard deviation, it correlates with an 8% increase in delinquencies and a 14% increase in new bankruptcy filings of entrepreneurs in the state. This is surprising because you thought having more friendly policies would reduce the burden on the entrepreneur. But what's happening is actually states that are more business friendly see entry of entrepreneurs that are observably of worse credit quality. So on the left of the index, you see states that are more business friendly. Here, individuals that enter into entrepreneurship, they have lower credit scores, they have lower income, they have lower levels of education, they have higher leverage when they make this transition. Okay, so having a more business friendly policy seems to be correlated with entry of worse quality entrepreneurs. And this is not just in the averages.
Sorry, Manasa, I was just wondering about this particular graph that you have. So is it necessarily the case that they're going to be worse quality, or is it that more people are now prepared to take more risk because of the fact that they have more guarantees with respect to what might happen to them if they don't succeed?
Yeah, so definitely the second is also true, and I'll show you that in like a couple of slides, which is, I think all I'm always saying from this is like in terms of like financial and credit quality, they seem to be observably worse, but that doesn't necessarily mean, that they're worse in terms of ideas that they have for starting a business, or they're lower quality in any other aspect. But yes, the insurance aspect is going to be a big thing, and I'll show you like maybe in just one slide if you hold on.
Okay, Manasa, just another question. So with respect to the quality, you have excluded those who are getting financing from venture capital, for instance, that there could be some screening going on with respect to the quality of the projects on an external market. Is that something you don't have data for, or is that something you're not considering?
Yeah, so we don't actually know if they also get, say, VC financing and so on, because at this stage, what we have is whether they're forming businesses and what happens, but not necessarily if they get financing from some of these alternate sources. We should think about whether we can potentially link some of that data, but at this point, we don't really know if they have VC financing. I think one of the angles we're trying to explore going forward is really what's happening to maybe some of these right-tail entrepreneurs, right? So the ones that do succeed and do really well, like, is that how large that group is and what's the impact on that group itself? But at this point, I think most of what we're going to show you will be averages and not really focusing on like the tails of the distribution, which might be some of the VC financed entrepreneurs.
So Manasa, there's an important question as to what the contribution of VCs is. So I think you might be able to tackle that in the sense that you have some of these who are going to be screened by VCs and financed by VCs, and the others are not. And is there a perceptible difference between the two groups? I mean, something worth thinking about maybe?
For sure. I think if we can find a way to like link that data, I think I agree. That could be very interesting. Yeah, thank you for that suggestion.
Manasa, you have technically 2 minutes, but I'm just going to give you like 6 because the questions will just eat into your last 10.
Okay, sure. Okay, thank you. But I will try to be quicker. Okay, so it's not just the averages that we see that this difference, right? So across the distribution, we see that the more business-friendly states tend to have individuals who seem to have, on higher credit scores and income than individuals in more business-friendly states. Okay, so I'm just going to skip ahead to other policies that could affect the individuals. Okay, so this is just going back to the insurance aspect that Naveen was talking about, which is, we know starting a business is risky, right? And if we can find ways to reduce the downside of entrepreneurship, it's going to benefit the individuals. And one aspect we look at is the level of homestead exemption. Okay, so this varies significantly across states. It's like $5,000 in Kentucky and $500,000 in Massachusetts. Okay, so this increased protection could provide a safety net for individuals, but it can always obviously lead to moral hazard and adverse selection. Okay, so what we're going to exploit in this test is typically these policies tend to be set at the state level, but there's a lot of variance in home prices within a state. Okay, so across different zip codes, home prices vary significantly. So the share of the house that's protected is going to vary, right? Meaning if you live in a house in a region where house prices are low, a larger share of your house is protected during bankruptcy. Okay, and we see if you have comparing individuals within the same state in the same year month, if you live in an area that is more protected from these downside risks, then the individuals who start businesses in these areas, they actually are more likely to be more delinquent on their loans, but we don't see differences in the levels of bankruptcy. Okay, in the last minute I'm just going to talk a bit about the channels. Okay, so what we're thinking of here is, we see that the personal debt of the individual is increasing after they make this transition to entrepreneurship, but there are different ways through which you could borrow, right? So for example, you can borrow through different mortgage accounts, you could draw down on a HELOC, you could do a cash out refinancing, or you could maybe have to borrow through credit cards or more expensive forms of non-mortgage debt. And what we want to show you here is, given the same level of total leverage, individuals that are able to borrow on these lower forms of debt, so typically being able to do mortgage borrowing instead of more expensive credit card non-mortgage borrowing, they have lower levels of delinquencies and bankruptcy. And what we see is the more sophisticated individuals, so the ones with college degree, higher income, they're able to borrow more on their mortgage debt and less on non-mortgage debt, even at same levels of total DTI. And we think this explains why some of the defaults and delinquency rates are lower for these individuals. Okay, so I'm going to quickly conclude so we can hear Erik's comments. So in this paper, we're using novel data on the universe of consumer credit panel, which we link to business starts of individuals, and we follow about 2 million entrepreneurs for 2 years before business start, about 5 years after the start of the business. And we show that once individuals make this transition to entrepreneurship, we see higher levels of borrowing and a deterioration in their personal credit conditions. And this effect is long-term because these changes, such as record of bankruptcy or delinquency on the credit file, stays for many years after the filing itself. We see also that having more business-friendly policies does not necessarily protect the downside for the entrepreneur, because it leads to entry of some observably worse individuals. And it's the borrowing on high-cost personal debt that seems to be correlated with these worse credit outcomes. Thank you all for the comments and questions, and I look forward to Erik's discussion.
Wonderful, thank you. So, Erik Meyer is our discussant. You have 15 minutes, and you will not get interruptions. So I'm gonna keep it at 15. Floor is yours.
All right, sounds good. Well, thank you very much to the conference organizers for the opportunity to discuss this paper, and to Manasa and co-authors for writing it. Okay, so I knew Manasa would do a great job presenting the results, so that makes my sort of summary pretty easy. Can do it in one slide. I think the authors assemble a really impressive data set here on the near universe of new business owners. and their personal finances with the information coming from credit bureau data. And they have sort of four main findings, which is that they can show us that after starting a business, entrepreneurs first, increase their personal debt levels, right? So mortgage debt increases by about 10%. Non-mortgage debt goes up by about 21%. And so this is, perhaps not surprising that these entrepreneurs are borrowing in their personal balance sheets, but sort of breaking down the breakup here is pretty interesting, right? And so second, they can show us that entrepreneurs are more likely to become delinquent and to file for bankruptcy. And the magnitudes here are sort of surprising, right? They find that entrepreneurs are 18% more likely to become delinquent and about 38% more likely to file for bankruptcy. They can also show us that the increases in delinquencies and bankruptcies are largest in states with business-friendly policies and generous homestead exemptions, which at first is a bit counterintuitive because you would expect these sort of business-friendly policies to sort of help entrepreneurs. But there's also this story where lowering the barriers to entrepreneurship brings in a broader set of entrepreneurs who may be less skilled and have sort of worse outcomes in their entrepreneurial endeavor and lead to these sort of higher default rates. So they flesh that story out a bit. And then as they're breaking down the types of new borrowing, they can show us that increases in non-mortgage debt are more strongly associated with defaults and bankruptcies than increases in mortgage debt. So those are sort of the four main findings that the paper presents. My initial impressions is, I think this is a great topic, right? I think, a deeper understanding of these financial consequences of entrepreneurship are important to us as academics. They're also important to policymakers who are supporting and incentivizing entrepreneurship, and they're important to entrepreneurs themselves who might want to recognize some of the downsides or the chances of bankruptcy from engaging in entrepreneurship. I think it's an impressive data effort here. The authors put together this credit bureau data from 2010 to 2019, covering US entrepreneurs who are starting businesses between 2012 and 2016. So very, broad, comprehensive data here. And right now the paper is sort of descriptive in nature. And I think the authors are sort of cognizant of that and careful not to overclaim. And given the sort of importance of the topic and how impressive the data are that they're bringing to bear on it, I think the paper can provide a lot of value. Okay, so the game plan for the discussion is, right now I think the paper is presenting us with a lot of new empirical facts in a relatively sort of streamlined fashion, right? And so my goal, and I think the goal going forward will be to add sort of framing and discussion and interpretation of some of these correlations and really interesting facts, right? So I'll offer a few suggestions in this vein. So 5 main comments, and then if we have time, 3 straight thoughts at the end. Okay, so first comment here is with regard to framing. So, we're writing a paper here about sort of the dark side or the potential downside to entrepreneurship, right? And I think the reader just can't help but wonder, is this bad, right? Is there too much entry into entrepreneurship, right? Or is the current level of entrepreneurship, higher than what is socially optimal? And so I think the authors can really sort of get out ahead of this and sort of say kind of what they're not doing in the paper, right? And just sort of head off referee number 2, right, from the beginning and say, okay, we're not making statements about, the social optimality of the current level of entrepreneurship because we're ignoring, the externalities of starting a business. We're focusing on, what's happening to the founders themselves. And then I think the second sort of caveat that needs to be added here is, okay, we're not thinking about these founders or entrepreneurs' welfare because there are all these non-financial reasons why people start businesses, right? They have a pride of ownership or utility from sort of being their own boss, right? So I think really sort of honing in on the question that the paper is trying to address is, does the average entrant into entrepreneurship benefit financially? Right. And I think, we're all sort of on the same page. The authors included, like, this is what the paper is trying to address. And so here there's some prior evidence on entrepreneurs' changes in income when they enter entrepreneurship, where the literature had traditionally found that, there was a reduction in these entrepreneurs' earnings, but some recent evidence suggests that that's not always the case. There may be increases in earnings or sort of a lot of value in the optionality of having these this variance in your earnings. And so I think the selling point for this paper is that it can shed sort of light on this question by using these entrepreneurs' personal credit info and sort of documenting the dark side, which we haven't been able to look at really before, right? So we can see bankruptcies and delinquencies and some of the negative credit experience of these entrepreneurs. And so a selling point to that is that, well, if these sort of downside events are not as salient to entrepreneurs, it might be particularly important to have these facts documented and presented to them. Right. So I think just explicitly framing the question with some caveats thrown in there will put sort of the dark side in context a little bit more in the writing. Okay, so second comment here, I think is one of the main comments, which is to kind of think about differences between what's happening in average outcomes versus sort of what we're observing in the left tail, right? And so at a few places in the paper, the authors are kind of saying, well, an increase in personal debt and a higher likelihood of defaulting on personal debt or filing bankruptcy may imply negative returns to entrepreneurship. And so I think the story that we kind of have in mind here is the one on the left, right? So here I'm just sort of drawing distributions of what might happen to a person's earnings in blue if they just stick with their regular job versus, in the red dashed line if they enter into entrepreneurship. And so if what's happening is that, the two distributions are pretty similar in terms of the variance, but the sort of earnings from engaging in entrepreneurship are lower, you have this leftward shift in the distribution. And then, how are we measuring these borrowers or these entrepreneurs' outcomes? Well, we're looking at defaults and bankruptcies, which I think are sort of arguably a left tail event, right? And so here I'm saying, well, you enter into default or bankruptcy if your income drops by 75% relative to what it was beforehand, just for simplicity. Okay, and so this leftward shift or these lower returns to entrepreneurship clearly generate these higher default rates and bankruptcies. That could absolutely be what's going on. But I think the story on the right is also pretty plausible, right? Which is that entrepreneurship is really increasing the variance in the person's future earnings, right? And so here the two distributions are mean zero, that you're just as well off in terms of expectation of your future earnings, but you observe a lot higher defaults because you have this much wider distribution in the earnings you might make in entrepreneurship. And you could even have the entrepreneurship distribution shifted to the right and still have this higher frequency of observing these left tail events. So I think we just need to be careful about, extrapolating from, defaults and bankruptcies to making statements about the returns to entrepreneurship. Now, I think there is still a ton of value in describing these delinquencies and bankruptcies because they're incredibly important events for these entrepreneurs going through them, right? And so the sort of suggestion here is just to be careful about extrapolating to returns to home ownership, or, if we want to do that a bit, present the results on this dark side sort of in tandem with some results on what's happening to entrepreneurs' financial health on average. Like that would be an even stronger statement that sort of inches us closer to making inferences about the returns. So now how could you do that? Well, you want some measures of financial health that can capture some of the upside variance of entrepreneurship, right? And so I came up with a few ideas here. I'm sure the authors will be able to do even better. But you could look at just long run changes in income. Now, if it's difficult to measure entrepreneurs' income in the credit bureau data, I completely understand. One thought would be to use the zip code income, track whether they're sort of moving to higher income zip codes as a measure of whether they're better off over time. I think you could also look at just long run changes in credit score, which, although they largely reflect things like defaults, they also reflect some of the upside of if you're doing better financially. And then as opposed to just looking at sort of the average effects, I think you could also break down sort of the percentage of winners and losers. What percent of entrepreneurs, have better credit scores in the future or move to higher income zip codes compared to these matched controls that you paired into. I think you could imagine a scenario where, something like 60% of entrepreneurs are better off than their matched controls, but the 40% of entrepreneurs who are worse off are much, much worse off and are generating this large increase in sort of defaults and bankruptcies relative to their matched peers. So I think just the percentage of winners and losers could also be informative here. The third comment, in the interest of time, I'll just try to do really quickly, which is to say that, the result that in these business-friendly states, you're finding these larger increases in defaults and bankruptcies, I think is really interesting, right? And it suggests that these new entrants into these states, sort of their reduced quality outweighs all the benefits of these business-friendly laws to the people who would always have entered as entrepreneurs, right? And so I think you can kind of play that up a bit. And it also begs the question or suggests that you might want to look at just how many people are entering in these states with the more business-friendly laws in your data. So right now, all of the emphasis is on looking at default rates and bankruptcies, but I think just quantifying the additional entry would be useful with the great data that you have. Okay, comment 4 is about the homestead exemption share results. And I think there are, the result is that there are larger increases in defaults and bankruptcies in areas where there is this higher exemption share, where the homestead exemption covers a larger share of your equity in your house, right? And so I think there are basically two types of variation in exemption share, right? First, there's the variation that's coming from the across state differences in the limits, right? So a $300,000 house in a state with a $100,000 homestead exemption is only 1/3 of your equities covered. In a state with a $300,000 exemption, it's fully covered. Right? So part of it's coming from the across state differences, but then there's also variations coming from within state differences in house prices, right? A $300,000 limit completely covers a cheap house. It only covers a small portion of a larger house. And so the current specifications have state fixed effects, right? And so we're really using the second piece of the variation here, right? These within state differences. And I think that's cleaner in some respects. And I can see why you want to do that, right? Because it's going to hold fixed a lot of state policies that influence entrepreneurship. But I think it could also be viewed as sort of repeating the sample split that you have earlier in the paper, which is based on entrepreneurs' income or skill level, in the sense that within a state, the areas where the exemption share is going to be high is going to be the lower house price areas, right? Those are also going to be the lower income areas, right? So I think, we could be kind of producing the same result, sort of couched two different ways. And so I think there are a couple ideas for how you could pin down the homestead exemption a little bit more carefully, which would be you could look at these homestead exemption tests separately for homeowners versus renters. And you might find that the results are really strong in the homeowner sample and much weaker in the renter sample, where the homestead exemption just isn't as relevant. You could view that as a placebo test. I think that would really suggest that the results are driven by these homestead exemptions. Or I think you could conduct a test that exploits just the across state variation in exemption share by doing something like, going and finding state border counties where the house prices are pretty similar on either side, but there's a large difference in the exemption limits, right? And so you might want to try it each way, exploit first the within state and then also the across state variation in these exemption shares. My last comment is just sort of a call to further explore why the type of borrowing matters as much as it does. So the current finding is that entry into entrepreneurship leads to these larger increases in defaults when the new borrowing is non-mortgage related, right? And so my questions here, is this due to sort of more skilled entrepreneurs having greater home equity ex ante, right? Or is it due to this story where there's a pecking order in terms of the debt that you're willing to repay? And you might be particularly averse to, defaulting on your mortgage and having your home taken away from you, right? So even equally distressed people might prioritize repaying their mortgage debt. Or third is, this is primarily emphasizing sort of the borrower's choice of debt side of things, but you could also look at sort of the lender's side of things. Is there differences in lender screening efforts? It may be more rigorous at mortgage lenders, and that's why you have sort of lower default rates after engaging in entrepreneurship. And so I'll sort of skip for the most part, the three stray thoughts. and just say thank you again for the opportunity to discuss this paper. I think it's an important topic. The authors bring exciting data to bear on it, and there's just a lot of potential to sort of dramatically improve our understanding of the financial